Hi, I'm Greg Stevens. I'm interviewing Dr. Siny Joseph, who is an associate professor of economics at Kansas State University Polytechnic. And we're going to talk about some of the impact and effects of the stimulus program and other economic issues in this program. A little bit about Dr. Joseph is she's a graduate of University of Massachusetts at Amherst, and she also has degrees in engineering and she has an MBA. She's been at Kansas State 8 years as a professor of economics, and her specialty is assistive health technologies and food policy and dairy farming. So I'm pleased to have you on the program, Dr. Joseph. Welcome.
Thank you very much. Thank you. I'm glad to be here.
Yeah, so there's been a considerable change in the economy. Not only has the stock market declined about 30%, which I'll be talking to other people about in a future program, but also we've had an incredible stimulus package that's been passed. I think this is kind of like the second program that they passed, and another one might be forthcoming. How do you feel about all of that?
In terms of the stimulus program, let me just back up a little bit and talk not just about the fiscal policy stimulus program, but also what the Fed has been enacting so far. So the two entities that are involved in providing stimulus is the Fed and the Federal Reserve, which is the Federal Reserve Bank and the federal government. So the one thing to note here is that before all this started, our economy was doing well. It was stable in the sense that our unemployment rate was at 3.5% and inflation was at around 2%. So the economy was doing well, and then all this happened. So from that perspective, what the Fed is trying to do is they're trying to provide that support structure, that environment to enable the economy to be stable and not collapse. And so they are creating that environment, but what really helps businesses and workers and people in the country are the direct stimulus, which only the federal government can enact. And that's where the 2.2 trillion comes in. So I just wanted to put everything in perspective. So the Fed, whatever they did, which we can talk about later, more specifics of that. So all of that was to make sure the markets function. But in terms of us, the people in this economy, they need to be helped, and that's where the stimulus came in. So, and as the economy recovers, or the timeline is decided by the virus. So once we are through this, then the Fed can step back in to kind of act based on how the economy needs to bridge that gap from where we are right now to where we need to be.
So you're thinking that once we get through this virus issue, that there might be another 2 trillion stimulus for infrastructure? Is that what I'm hearing you say?
So based on all that I'm reading about, like I said, we have had multiple stimulus plans and they have been passed, the latest being the 2.2 trillion. But as we go along, policymakers are looking at, they believe that this is not enough. And if this continues, then more needs to be done. And that's where they are talking about the next one, which is the 2 trillion on infrastructure. So it's not after the recovery, it's during this period of this pandemic situation that we are in, that they're thinking of what next needs to be done.
Okay, so let me ask you this question. In 2018, we had a $1.5 trillion tax cut.
Yes.
And so now we're talking about a 2 trillion stimulus and possibly another 2 trillion. Is that something that our economy can stand?
So that's a good question. But the thing is, at this time, we are talking about a situation where the steps to alleviate health crisis through social distancing is actually exacerbating the economic crisis. So when this is being purposefully done, and all the stimulus that we're talking about is not to stimulate the economy, it's just to make sure that the economy does not collapse. So when in this situation, it's difficult to kind of question the amount that is being pumped into the economy, because it is necessary, it has to be done. So now talking about the 2018 tax cuts and this current uh, stimulus plan, this is all adding up, of course, to the national debt. There's no escaping that. But eventually, when workers start working again, when businesses start producing again, and so on, there will be tax revenues coming in as people start spending and so on. But and there will be pent up demand based on the situation that we are in. We expect there to be this pent up demand, which will once the recovery happens, all of that will stimulate the economy. People will start spending, loans with all the 0% interest rates. People will start spending more and so on. Revenue will come in, but not to the extent to cover this deficit that we'll be in the debt. But that's something something to be thought about at a later time on how to deal with. At this time, we need to do what is important, what is necessary for the economy to survive.
So I might be putting you on the spot here, but if we were to compare COVID-19 and the stimulus program today with the Great Recession that we just had and the Great Depression, what would that comparison look like?
Yes, that's a good question. Great Depression, I just want to talk about some statistics first so that we can put these three situations in perspective. So in the Great Depression, real GDP fell greater than 25%. Great Recession, which was 2007 to 2009, a recession which spanned across 6 quarters, the real GDP fell at an annual rate of 8% in the fourth quarter of 2008. And the unemployment rate was above 6% till fall of 2014. Now coming to this current crisis. 4 weeks earlier, like I said earlier, the unemployment rate was 3.5%, and barely 200,000 people applied for jobless benefits. As opposed to last week, 3.3 million people applied for unemployment benefits. So that tells us we can estimate the unemployment rate currently to be at around 5.7%. Now going forward, by the second quarter, there are around 46% of the people who are working who are at a high risk of layoff, as opposed to 54% of people at a low risk of layoff. So this 46% are high risk of layoff. So it is quite possible that we'll have more unemployment claims and so on by the second quarter. So that means we are kind of looking at an unemployment rate in the range of 10% to around 40.6%, depending on how many people are laid off.
From 10% to 40.6%?
Yes, 40.6%. That's what I am reading other economists predicting. So yeah, that's the range we are looking at.
And Kansas, I think, just released their numbers yesterday.
Yes, and I saw that the claims ballooned from 1,820 to 23,000. So that's around an increase of 1,000% in Kansas alone.
Wow.
Yeah.
You were talking about monetary stimulus and fiscal stimulus, and fiscal stimulus being what would help the economy more than the monetary stimulus. Why don't you explain for those that maybe need a short refresher course in economics, the difference between monetary stimulus and fiscal stimulus,
All right.
and to start with here.
Okay. So the monetary stimulus is enacted by the Federal Reserve banks. So what they, and even though you mentioned that fiscal is required, monetary is also required, they both have a role to play. And we saw that in the Great Recession, 2007 to 2009, both these entities did work their magic, so to speak. So the Federal Reserve did buy large-scale assets called quantitative easing and lowered the interest rates to zero. Similarly, the federal government also provided a stimulus plan of around $800 billion. So that was then. Now, talking about the Fed, some of the things that the Fed has done in terms of the monetary stimulus are that they lowered the interest rates to around zero. That was on March 15th. They purchased treasury securities and mortgage-based securities, and that has led to the federal balance sheet at $4.67 trillion. So that's where the Federal Reserve's balance sheet is based on the stimulus that they are enacting. They have also lowered the discount rate, which is the the interest rate that commercial banks pay to the Federal Reserve for taking the discount rate. So earlier, the discount rate would always be higher than the federal funds rate. And the reason being they wanted banks to lend each other or borrow from each other. But now they are encouraging, incentivizing commercial banks to actually borrow from the Fed. And that's why they have lowered the discount rate around the federal funds rate. They are also lending cash directly to businesses for payroll and so on. They are also lending to foreign central banks because there's demand for dollars. And again, this is at 0%, near about 0% interest rate. So these are some of the things that the Fed is doing. And like I mentioned earlier, again, to support the economy, this does not directly help consumers, workers. It does help businesses to some extent, yes. But now comes the fiscal policy, which is enacted by the federal government. And whenever we talk about tax cuts, government spending, we are talking about fiscal policy. And that's where this 2.2 trillion CARES Act that was recently passed comes into play. And some of the key highlights of the stimulus plan was that they are directly paying to individuals. And if you are an individual earning less than 75,000, then you get 1,200 as cash payment. And if you have kids under the age of 16, then each kid is allocated $500. But if your income is greater than 75,000 to around 99,000, then the cash payout is phased as it goes above 75,000. So that's one thing. The other was the expanded unemployment coverage. Now this is kind of important because this was one thing that many economists were talking about, that if you really want to help the workers and so on, the people in this economy, you need to expand the unemployment coverage simply because you are forcing people to stay at home, right? And you want to resolve this. So then you need to provide support. And that's where this comes in. And the key features of the unemployment benefit is that they have expanded the benefits to self-employed, part-time, gig workers, freelancers. So that's one. The second thing is that they are providing $600 per week in addition to the state benefit for an additional time period of 13 weeks, as opposed to just the 26 weeks that are scheduled for benefits. So that's an additional, so a total of 39 weeks. So that's about the unemployment benefits. Then student loans, they are waived for 2 months of payment. Changes with the retirement account rules as well. So you can withdraw up to 100,000 without the 10% penalty. You can spread out any income taxes owed across the 3 years, and also put money back into the account before 3 years. So these are some of the key features I would think worth discussing about the stimulus plan.
Are there any other programs that the feds could implement that might complement the ones that you've just discussed?
So yes, many more stipulations within the stimulus plan for renters, there's an eviction moratorium for landlords with mortgages which are backed by Freddie Mac and Fannie Mae or other federal agencies. Penalties for no fees or penalties for rent non-payment for 120 days. Small business loans, corporate aid, especially to the corporate companies that are crucial for national security. And then there are also some provisions for around 100 billion to healthcare providers, 16 billion for stockpile of medical equipment, personal protective gear, expanded health, telehealth, and so on, and around 150 billion state and local government that are saddled with costs associated with the virus. But in general, it is viewed that this stimulus plan does not provide enough to the state and local government and for healthcare providers and for equipment. They are saying that there should be more. This is not enough. So maybe this is something that will be considered going forward in the next stimulus plan.
How about the global economy? What's happening there?
So with the global economy, all eyes were on China, and because that's where it all started. And the Chinese economy in the first quarter fell by 10%. And that's the cue that other economies around the world are taking, that we would expect our economy to also fall in that range. So the global economy as a whole, we can see that the supply chain is upended. So one thing that economies have realized is that it's difficult to, rely on global supply chain. So either they kind of work towards developing their own supply chain or working around it, or they could all come together and make sure that in such a situation, we are all in this together. So I don't know which way they'll go, but this is something that's kind of being highlighted at this time.
Do you think that given what you've just discussed, that we may see more of a growth in local economies and localism?
Absolutely. So I do think that given our situation where we are kind of closing our borders, isolated, depending on what do we have, help sustain our economy, especially when the global supply chain is unreliable, as we have learned. So for sure, it is the local economy that's stepping up to fill this gap as best as they can. And I think we need to recognize that. And I hope that going forward, as everything is re-evaluated in the context of in the future, what if something like this happens? How do we make sure that we are compliant to some extent? In that situation, I think it's the local economy that we need to recognize that, and we need to incentivize and encourage them to be to play a major role in our economy.
Now, to me, that kind of flies in the face of what's been happening the last 30, 40, 50 years, which is economists, this word free trade, which has given us a lot more of the global economy, hasn't it?
Yes, and we are seeing the effects of that, aren't we?
So are
Who
economists
would have
going to now
expected?
start thinking about local economies more?
Well, as an economist, I have been, learning and reading a lot about the emergence of the local economy as well. So, yes, the global economy has always been in the news, especially with the trade and all of that. But that is not to say that the local economy did not have a place. It's just that the emphasis was always on globalization and how it benefits and its impacts. But now the focus or the scanner is now on the local economy, and that's why we hear more of it, and rightly so. So I think this is a great opportunity to kind of see the ways by which they can be supported, and further identifying what can be done to make sure they are thriving.
Okay, so that's going to be an interesting change for the future, because it seems like we've not incentivized the local economy. And you mentioned earlier that there may be more of that taking place. So it'll be interesting to see how that comes off, whether that comes off or not.
Yeah, and if I may just add, we've been talking a lot about the macroeconomic impacts in terms of the economy, unemployment, and so on. At the micro level, when we talk about markets, where you just talked about the local markets, local economy. Similarly, we are going to see big changes in the way the markets will turn out to be going forward. So we all know that brick and mortar businesses are severely affected. Theaters, concerts, funerals, bars, boutiques, all of these businesses are affected. And last year, 9,300 stores closed. And this year, additional 15,000 stores are expected to close. So that's the impact on the, in the micro aspect of the economy. So we all know that there was a push towards online, and now that's going to speed up. So any business with minimal human contact, like grocery deliveries, online learning, takeout food, streaming video, all of that is going to play a major role going forward. And Amazon, Walmart, all of them are adding more workers when other, brick and mortar businesses are laying off. These are the big companies that are actually hiring more. So there's going to be a fundamental shift or structural shift in the way people work. More than maybe 25% of employees will continue to work from home. They might have staggered hours. Teams may rotate going to office, things like that. And one thing I think it's worth mentioning is that inequality could grow wider if companies used this pandemic as a catalyst to automate more jobs and use more contract workers. So these contract workers may not receive the benefits, and it is always easier to fire them in a downturn. So those are some of the shifts we might see going forward. So I just wanted to make sure when we talk about the local economy, we also need to look at on a broader scale, how does that impact specific markets within the economy?
So those aren't minor issues. They're somewhat significant in going
Yes,
forward.
absolutely. Yes.
You mentioned earlier, and I want to go back to interest rates, that interest rates were almost down to zero. Can they go below zero?
So some countries, they are negative. So for example, in Europe, they have negative interest rates. And they had negative interest rates even before this pandemic, actually. I believe there are some other central banks as well who have interest rates at negative. But in the US, they are trying to prevent that. The Federal Reserve is trying not to get there where the interest rates are negative. So that's why we are at zero, and they're trying other creative approaches, other alternatives to, ensure that the economy is stimulated and not just rely on one instrument, which is the interest rates.
So what happens when interest rates go below zero?
Oh, well, if it goes below zero, then you have to pay for the money that you keep in the bank. That's what it means.
That's a change.
Yeah, so, not that we get anything for the money that is in the bank, but this is more for commercial, commercial banks. So not so much for savers or regular consumers.
Okay. So we've covered quite a few topics here, Dr. Joseph. Anything else you want to add in relation to the stimulus or the economic outlet that we see today?
Well, this is such a dynamic time in terms of, every day we are looking at new numbers, not just in terms of casualties and so on, but also in terms of what needs to be done, given that the economic situation is such. So everyone always seems to be surprised. We know that growth is going to slow down. We know all the stimulus that has been pushed in is not going to stimulate demand or stimulate the economy. It's only to get the economy floating. So we know all that, yet we are surprised every day with the numbers that come in with respect to the unemployment benefits, unemployment claims that are being made, and so on. So I know for sure that all this is being considered, and the general consensus is you have to act bold, you have to act fast, and you have to overreact rather than underreact. So you have to err on the side of where you do more for the economy than less. So for sure, all this is going to add to the debt and so on, but that's a different problem that we will face once we get out of it. So it's important to get out of it first. So I think how much ever is done is, more should be done, especially in terms of providing enough stimulus to the healthcare industry, and because they are the ones who are on the front lines and doing every resources should be available to them to do their job well.
I have a couple more questions.
Right.
In terms of the local economy, what can we do to maintain growth? I suppose maintaining would be preferable to where we might be heading. And number two, is growth a good indicator to measure sustainability and resiliency for the future?
So to answer your first question, what needs to be done to maintain the local economy? Is that correct? Is that what you asked?
Right. Yeah.
So as of now, in the stimulus plan, there are loans and availability of cheap loans and so on to help local businesses, and with the stipulation that you continue to keep your workers, to not lay them off. If you lay them off, then the stimulus plan accordingly adjusts. So they're trying to ensure that businesses don't go bust, they maintain it. the word that you used. So there are provisions, and I often wonder if people know about it, because I don't know how many people go and read the entirety of all the benefits that they can avail of. So it is very important, one, to be aware of all these different stipulations in there, which might be of help. And there are also, of course, many challenges, because this is unprecedented. And if there are kinks in the system, they don't know how to fix it yet. So there could be issues that come up as this is implemented, but that is not to, the first thing is to be informed. The second thing is to take advantage of the various stipulations that might be relevant to you as a business, local business, and ensure that you, help yourself based on what is allocated to you. So I think there are enough, and as we go along, like I said, if this continues, since the timetable is not known yet, if this continues and there are more stimulus plans in the offing, then again, be aware, be informed, and continue to see how is it, how can you benefit from all of this and as relevant. So that's the first question that you asked. And the second was, how do you ensure sustainability? And that's where
is growth still important to sustainability? Can we have a no growth economy and be more sustainable? This might be a tough question to answer.
Yeah, I think I need to kind of contemplate more on this question and not just speak off the cuff on this one.
Well, can we grow forever?
We can not, no economy just grows forever. There's always punctuated by downturns, right? Like what we are seeing now, which may be designed by business cycles or otherwise, like this case. So growth cannot go on forever, but when growth goes down, those are the times when creative ways come up for the economy to kind of readjust. And so, which we call as structural changes, right? So when these structural changes happen, or the shocks to the system as we see it, that's when you need to, creative ideas come up, and sometimes it's painful, sometimes you just have to adjust, sometimes you have to look at a new way of doing things. So that's all part of the process. So I can say for sure growth will not happen forever, but it is in these downturns that you have to think of what are the efficiencies that should be leveraged to ensure that going forward it is sustainable till the next downturn happens, when we reevaluate and decide how best to do things at that point in time.
So what you're saying kind of supports this idea of innovation and creativity as an important concept for people to try to pursue.
Yes, disruptions in the system always leads to new equilibriums, and those equilibriums are supported by creative ideas. Either if you can go as before, stick to what you are doing, and if you can continue that way, fine. Most of the times you cannot. So that's when you have to be creative, innovative, such that you can adjust to that new environment and do things better or more efficiently, and so on. And like everything, change is always difficult, but then sometimes it is necessary, and sometimes it might lead to better opportunities and so on. So one should be open-minded for sure, and sometimes you have no choice. So then you just have to do it.
So on that positive note, it's been a pleasure visiting with you, Dr. Joseph, and it's wonderful to have such great talent here in Salina, Kansas. We've taken a kind of a wide view at the issue with some positives being discussed. And this is, like you said, some significant times here. I'm Greg Stevens for Salina Media Connection, and we appreciate all you viewers, and we appreciate Dr. Siny Joseph sharing some thoughts with us. Thank you.
Thank you very much, Greg, for having me on this show. It was a pleasure talking to you. Thank you.
Yep.